Okay, let's work through an example with using these kind of the four methods we've talked through for depreciation. So here is our scenario. We have a corporation that purchased a new machine for its assembly process on August 1st, 2017. The cost of the machine was $150,000. The company estimated that the machine would have a salvage value of $24,000 at the end of its service life. Its life is estimated at 5 years, and its working hours are estimated at 21,000 hours. So the year end is December 31st. Okay, let's work through this. We're going to start with our straight line method. The straight line method, this machine has 5-year useful life and a depreciable base of $126,000. So in our first year, we take 1/5 of 126. That gives us $25,200. It is a partial year because, again, we did not have it the whole year. We only had it for 5 months. So we're going to multiply times 5/12, which gives us current year depreciation of $10,500. And then we're going to move on to our next year. In the next year, in 2018, the depreciable base stays the same. We still have 5 years. The annual depreciation rate stays the same, but we have a full year of depreciation in the second year. So our current year expense is going to be the full $25,200. Now, we just continue doing this every year. We continue adding to 1/5 of the depreciation. The depreciation amount stays the same for essentially those 4 years because it's straight line, it doesn't change. And then in the last year, we have this. Again, the last year is going to be another partial year, just like the first year was a partial where we took 5/12. In the last year, we're going to take 7/12 of depreciation. So that's going to be a little bit different, and it will bring us down. It'll only have $14,700 of depreciation, which gives us accumulated depreciation of $126,000, which is equal to our depreciable base. And then we're all done. So that is straight line method. Very straightforward. Activity method. Now, again, our activity method, we were assuming 21,000 hours of activity on this piece of equipment and assuming a depreciable base of $126,000. That means we have $6 per hour is our charge for this piece of equipment. So in the first year, we're going to use 600 hours times our $6 per hour gives us an expense of $4,800. Well, partial year doesn't matter, so our depreciation expense is $4,800. For the depreciation expense, we're going to record with a debit to depreciation expense for $4,800 and a credit to accumulated depreciation of $4,800. Now, moving on to the sum of the year's digits method. Again, this is a declining cost method. So sum of the year's digits, we're going to take our first year of 2017. We have a depreciable base 5/15. Again, this is a 5-year useful life. The first year is 5/15. Our annual expense is going to be $42,000. Now, this is a partial year. For some of the year's digits or these declining balance methods, in the first year, we're just going to take the 5/12 of whatever the amount was supposed to be calculated at, which gives us a depreciation, current year depreciation expense of $17,500. Now, we make our journal entry for depreciation expense, debit depreciation expense, credit accumulated depreciation. Okay, so then in the second year, we're going to take, the second year, if it was a full year, we would actually take, what would it be, 4/15. Now, we do have a partial year from the year before. Now, how much of the partial year do we have? Well, the first year was 5/12. The second year is 7/12. So 7/12 is actually 0.58333 is the calculation there. So we're actually going to take 4.58333 over 15. That is the depreciation percentage that we're taking. Instead of a straight 4/12, we're taking 4.5833, which is 4 plus 7/8 of the year, which gives us a annual expense of $38,500. There's no partial year this year, so that gives us that is our current expense for the period. Now, again, that was multiplied times its depreciable base. Now, as we move on to the next period, we take depreciable base and we multiply that times 3.58333 over 15, which is, again, that's 3 plus the 7/12 of a year that we keep dragging every period, which is the remainder from the fact that we only had 5/15 of the, or sorry, we only had 5/15 of the year the first time. So we multiply that times our depreciable base, which is $30,100, and it's a full year, so that's what we're going to use. Then we move on to our next year, which is 2.58333 times the depreciable base, which gives us $21,700. We just continue doing this until we get to basically the end. In the last year, we are going to be taking 7/12 instead. It's basically 0 plus 7/12, just like in the first year it was in the first year it was 5/12. In the last year it's going to be 7/12, which is 0.58333 of the depreciation in the last year. So our annual expense in the last year will be $4,900, and that will end up fully depreciating our assets. So we will end up with a total accumulated depreciation of $126,000 at the end of this whole process. So that's how you do some of the year's digits if you're ending up with partial years. Moving on to the double declining balance method. This is a declining balance method. This is double, which means we're doubling our straight line rate. So if you remember here, the big difference in double declining is that we are not using the depreciable base. We use whatever the purchase price is, and we stop depreciating when we hit salvage value. And every year we're using the net book value to calculate the depreciation, not the depreciable base. That's the big difference when we're using these declining balance method, as opposed to all the other methods where we determine a depreciable base and then we use all of that depreciable base. So let's start with our net book value of $150,000. Our rate of depreciation is going to be 2/5, double the straight line rate, which would be 1/5. So 2/5, that's 40%. Our annual expense would be $60,000. However, the first year is a partial year. It's only 5/12 or 5 of the months. So we're going to multiply times 5/12, which gives a current depreciation of $25,000. Now, in the second year, after we make our journal entry, in the second year, our new book value, or our net book value, sorry. This is our net book value, sorry. It's not the depreciable base. It is our net book value. In the second year, we take our new net book value, which is $125,000. We multiply that times, you guessed it, 40%, gives us our depreciation of $50,000. It's a full year, so we use the whole amount, and our current year expense is $50,000. In our third year, we take our new net book value, which is $75,000, times 40%, or 2/5, gives us $30,000 of depreciation expense, and a new net book value of $30,000. Or sorry, depreciation expense of $30,000, a new net book value of $45,000. The $45,000 times our 2/5 gives us $18,000. The $18,000, that's our expense. And in the last period, we have $27,000 left. Remember, our salvage value was only $24,000. So we can't run a depreciation expense of $10,000 through in the last year, because we have to stop at $24,000. So we're only going to take the 27 down to the 24 through a depreciation expense of $3,000 in the last year. That gives us a salvage value at the end of this period of $24,000, and we're all done. So that is the double declining balance depreciation method. So there are some other special depreciation methods and issues that we'll talk about here. So we can take a group method or a composite method. These are two things that can be done. If we take a group method, for instance, in a group method, what we do is we take a bunch of assets. They can be similar, they can be totally different. It doesn't really matter. We're going to take a bunch of assets, we're going to group them, and what we do is we take the weighted average when we're calculating depreciation. So in this, okay, sorry about that. There was a fish just rolled like 12 feet off the bank here, and I didn't even have my line in the water. So I went and tried to get it in front of it, but it was gone. Anyway, moving on. Let's talk about the group method. So we have an example here. Mooney Motors establishes the composite depreciation rate for its fleet of cars, trucks, and campers. What we end up with here. So we're going to take all of these assets, the original cost, and then the residual value gives us our depreciation cost. So that's how much we're going to be depreciating these assets. And then we're going to take their estimated useful life. We're going to use that to figure out what would be depreciation on a straight line method basis. For instance, you could use whatever method you want, but we're going to assume straight line, and definitely simplifies this type of calculation. So we're going to take our straight line method in this case and basically figure out kind of like a weighted average life expectancy. And that is what we're going to use. So we're going to figure out, okay, well, what is our depreciation for all of these, assuming a straight line basis, and we're going to calculate a rate. In this case, we're calculating a rate. It's going to be 25%. So our depreciation is going to be 25% every year. So 25% of these assets. And that is essentially a weighted average useful life of these assets. Some of them last a lot longer. So 25% a year assumes a 4-year useful life. If you notice, some of these assets are 3 years, some are 5 years. But we're using 4 years, which is essentially the weighted average of those assets that we have. So that's a composite method where we can group assets, and you do that based on figuring out, okay, well, what is the kind of weighted average life expectancy if you're using a straight line method. Now, let's say Mooney retires an asset before or after the average surface life of the group is reached. It buries the resulting gain or loss in the accumulated depreciation account. Again, because you don't know the value of that specific asset because you aren't tracking that specific asset's accumulated depreciation. So in this case, what the journal entry we're going to make is going to be to accumulated depreciation. So we're going to debit accumulated depreciation of $24,000. We're going to sell this asset. So we're receiving cash of $2,400, and we are reducing the value of the composite group of assets by $5,000. That is our journal entry that we're going to calculate. Again, there's no gain or loss here. We're just pulling out what we can and trying to bury whatever the difference is essentially in the accumulated depreciation account. So we just drag any gains or losses that could have resulted in this transaction, just get kind of stuffed back into the assets. If it's a gain, it reduces the value of the assets. If it's a loss, it ends up increasing the value of the assets just mechanically. So that is a group method. There's also a composite method, or just any kind of a hybrid method, right? So anything that's, again, systematic or rational can be used. So you can combine methods. Maybe part of an asset depreciates routinely over time. So you want to straight line half of the value, half of the cost, and use production for the other half, for instance. So that's what this WHX Corporation, I'll put up their footnote disclosure here. That's what they do essentially. One piece of their asset, they say it just expires with time, and another aspect is based on usage. So they calculate depreciation that way. Again, as long as it's systematic and rational, they can do it. It doesn't matter. So some other quick methods, other things that we would talk about here. How do companies compute for partial periods? We've already talked through quite a bit of partial period stuff when we work through the examples. Does depreciation provide for the replacement of the asset? This is a common misconception. No. Funds for the replacement of an asset come from revenues. They don't come from depreciation. Depreciation is the using up of an asset. It provides there's no cash that follows depreciation. The cash went out the door when you bought the asset, it doesn't come back in the door when you depreciate it, as we saw when we did our cash flow. And how do we handle changes in the depreciation rate? And fortunately, we have covered this already when we talked about accounting for changes in estimates, because the depreciation rate, or the time of the depreciation, is a change in an estimate. This is done going forward. We do not go back and do this separately. So I am not going to cover a full example of changes in depreciation rates here, because we've already talked about it. We talked about changes in accounting estimates in a much earlier slide. But in short, what you do is you change depreciation going forward. So for whatever period has not been used up yet, let's say you had 5 years left and you think it's going to be 10. Well, you take whatever your net book value is, and instead of going over 5 years, you go over the remaining 10 years. You don't go back and change anything, because again, it is a change in an estimate. So that pretty much wraps up what I wanted to cover for this section. In the next section, we'll move forward and kind of wrap up, probably cover the last couple of things within this section, particularly impairment and depletion of assets. So with that, have a great day. God bless.